We've got Chapter 17 happening here, Mortgage Underwriting and Borrower Qualification, Lesson 13. Now, luckily for me, many of these questions are math, and I don't need to read them out. Because reading math questions is doable, but listening to them in the car or on my cell phone, it doesn't work. Why? Because math questions, you gotta actually see them, and it's hard to read them out. And yeah. Anyway, you know all that. Okay, so we're just gonna flip through these things and see quickly if there are, oh, here it is. Question 60. Question 60 on page 4. Which of the following are included in the residential borrower qualification process? And the answer is for all of the above. So all of the above, A, the collection of, so this is when you want to qualify for residential borrower. A, the collection of information about the borrower and the property. B, the evaluation of the applicant's ability to meet the terms of the mortgage and the amount of their income. C, the analysis of the real property pledged as security for the loan. And D, the analysis of the applicant's credit report. So all these things go into helping to qualify a borrower for a residential property. You collect info about the borrower and the property. You evaluate the applicant's ability to pay their income, yes, and you analyze that real property, its quality, as a security for a loan that's pledged, and you do a credit record check. Doesn't that sound awesome? I think it does. All right, now we're going to just, okay, so a lot of these questions about maximum payments, GDSR, what do you call it, L to V, what is it called? Loan to value ratio, maximum, annual income. All right, so we got a question here, 178. And the question here is lenders who are attempting to ration mortgage funds could, number one, decrease their gross debt service ratio, the GDSR. Lenders who are attempting to ration mortgage funds could, number one, decrease their gross debt service ratio. Interesting, huh? I don't even know what the hell ration means here. But I will read this here on page 12. Rationing mortgage funds means to reduce the amount given out to mortgage loans. By reducing the gross debt service ratio, in brackets we say the PIT or the gross income, or PIT over gross income, the lender decreases the amount of the loan for a given gross income. 2, decreasing their interest rates doesn't decrease the amount lent out. It just creates a greater demand for loans. 3, increasing the maximum loan to value ratio means for a given market value of the property, the lender is willing to advance a greater amount of a loan. And 4, increasing the maximum amortization period, all other factors constant, means the present value of the loans will decrease, since borrowers are given more time to pay off the loan. So you increase the maximum amortization period, you decrease the PV of the loan. Sounds so cool, huh? All right, and then we are moving right along. We've got something here on, we've got 2 questions here, actually, on page 13, question 188. With respect to an insured mortgage loan, which one of the following statements is false? And the answer is 4. The lender has only the personal covenant of the borrower and the value of the property for security. That's not true. You got more than that for security, other than the personal covenant and the property value. All right. Number 1 is true. Default insurance is paid for by the borrower. 2, the borrower can add the premium to the mortgage amount. And 3, if the borrower defaults, the insurance company will guarantee that the lender will recover all capital invested. Yes, those are all true, but this is false. 4, The lender has only the personal covenant of the borrower and the value of the property for security. No. 204. The loan-to-value ratio is the ratio of, for the face value of the mortgage loan, okay, face value of the mortgage loan divided by the lending value of the property. So the face, this is true. The face value of the loan is divided by the lending value of the property. So that is the loan to value ratio. The loan, because the loan you're going to give, and value of the property. Loan to value ratio. 204. Does that sound wonderful? Okay. Moving, rolling down the river. Ding, 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 ding. Now we got necessary. Oh, yes, we got 279 here. 279. And the question here, among other factors, the maximum amount that the buyer of a residential property may borrow is affected by, and it's number 4, all of the above factors. 1, the buyer's income. 2, the lending value of the property. And 3, the prevailing mortgage interest rate. So all these factors are at play. That's 279. Yes. Alrighty. Now we got 347. Which of the following is not a procedure commonly used by a large institutional lender in order to reduce the risk associated with a particular mortgage loan? And 347, the answer is 2. Increase in the interest rate charged. Increase in the interest rate charged. That is not a common procedure to reduce the risk. They just increase the interest rate. No. But these other things are procedures to reduce risk. 1, reduction of the loan to value ratio. 3, reduction in all the in the gross debt service ratio, the GDSR. They can do that. They can reduce the loan to value ratio. They can reduce the gross debt service ratio, but this one is not a procedure used by banks and lending institutions to increase in the interest rate charged to decrease the risk. No, they don't do that. And then we move right along. 368 on page 24. In commercial mortgage underwriting, the factor calculated by dividing the annual net operating income, the NOI, by the annual sum of mortgage payments, and that is referred to as number 3, the debt coverage ratio. The debt coverage ratio. Debt coverage ratio is putting the NOI divided by the annual sum of payments, the sum of payments, the annual sum. All right, so that's page 24. Yeah, debt coverage ratio. 445. The lending value is, the answer is 2. A long-term conservative estimate of the value of the interest in land pledged to security. Lending value is 2. A long-term conservative estimate of the value of the interest in land pledged to security. 456. When borrowers increase their maximum allowable loan by accepting a shorter term and lower interest rate, the borrowers have, and the answer is 1, an increased degree of risk regarding changes in the interest rate over time. So when borrowers increase their maximum allowable loan by accepting a shorter term and a lower interest rate, the borrowers have, number 1, an increased degree of risk regarding changes in the interest rate over time. On this on page 24, by the way. Interesting, huh? Let's all right, so we're doing page 26, 457. And 457 here is, which of the following statements regarding financial covenants of the mortgagor, the borrower, is false? And the answer is 2. This is a lie. Lenders always make the property tax payments for the borrower to ensure that the property taxes don't fall into arrears. No, lenders do not do that. But they do these things. 1, the 3 main financial obligations of the borrower, in addition to repayment of the loan amount, include payment of property taxes, property insurance, and property maintenance. And then 3, the mortgage loan agreement should contain a covenant by the borrower to insure the property against fire and other specified hazards to the full insurable value of the security. And 4, the borrower should maintain the property in a manner that will preserve the value of the security in order to reduce the capital risk. All those things are true. Okay, that was on page 26, question 457. Alrighty then. 596. 596. The risk to a mortgagee can be reduced by 3, reducing the loan-to-value ratio. You reduce the loan-to-value ratio for potential borrowers, and the risk to the mortgagee can be reduced. That's on page 31, question 596. Alrighty then. And then we're moving to page 34. We've got like a whole whack load of questions that are not math. So, we're going to 652. Yes. 652. The process used in underwriting income-producing properties is similar to that for residential borrower qualification, except that in underwriting commercial properties, number 2, the income from the property is more important than the personal income of the borrower. So, okay, now when we're talking about commercial here, the process used in underwriting income-producing properties, that's the properties, commercial properties that have NOI, that is similar to that for residential borrower qualification, except that in underwriting commercial properties, all right, so we're trying to contrast the residential and the commercial properties. So on a residential property loan process, they're going to look at the borrower's income. But for the commercial, they don't look at that as much. They look at number 2, the income from the property. That's more important than the personal income of the borrower. Okay, 663. All right, 660. With respect to an insured mortgage loan, which of the following statements is false? And the answer is 3. Canada Mortgage and Housing Corporation, CMHC, is the only institution in Canada that provides mortgage loan insurance. That's a lie. There's another one. It's called, what, Genair or something like that. Canada Mortgage and Housing Corporation, CMHC, is the only institution in Canada that provides mortgage loan insurance? No. Oh, it's Genworth, sorry. The other one's Genworth, so that's a lie. Now, these other things are true. 1, in Canada Mortgage Loan Assurance, the lender pays the insurer a single premium, the cost of which is generally passed on to the borrower. 2, borrowers can add to the mortgage loan insurance premium to the mortgage amount. And 4, federally regulated financial institutions require mortgage insurance, right, in order to make loans with loan-to-value ratios higher than 80%. So let me just say here, those other things are true, but the false one is CMHC is the only institution Canada provides mortgage loan insurance. That's a lie because Genworth is the other one. 666, number of the beast. The purpose of the credit analysis of a mortgager is 666. 1, to ensure that the borrower has both the ability and the intention of complying with the mortgage agreement. So the purpose of a credit analysis of a mortgagor is 666-1, to ensure that the borrower has both the ability and intention of complying with the mortgage agreement. So that's why we do the credit check. 668, when a borrower is unable to make the mortgage payments in part or full, this may occur because of 6684, all of the above. 1, changes in market conditions. 2, sickness or accident. 3, loss of employment. So all those things can cause somebody to default on their payments. You got that? Yes, I do. Moving right along. We're nearing the end. The end is near. The end of... Oh, yeah, now we got 922. I knew we'd have something more. Which of the following statements is false? This is on page 43. What is a lie here? And the answer for 922 is 3. The market share of Canadian subprime mortgages is much larger than in the U.S. That's a joke, and that's wrong, and that's our answer. These other things are true. Subprime lenders account for risk by charging increased interest rates. Yeah, so you get a second loan on your property, you're going to have a higher interest rate. And they also incorporate higher admin and processing fees compared to prime lenders. So you got higher admin fees and processing fees. And number 2, one of the problems in the U.S. subprime market arose because the subprime boom introduced lending practices that made it easier to obtain loans. That is also true. And 4, the Canadian subprime market is subject to less risk than its American counterpart because all high-ratio Canadian mortgages must be secured with mortgage insurance. That's another good thing about Canada. We force everybody to have mortgage insurance. But the answer, because we are looking for the lie, the false thing, the market share of Canadian subprime mortgages is much larger than Uncle Sam's, and that is a total blatant freaking lie. Finished. Lesson 13.